Hi, this is Randy Finney with Right Side of the Chart, and this is a closing market wrap for Monday, October 11th, 2021. I'm going to start out with a brief update on the broad markets. I also want to share some what I'm calling additional potential targets. They're not my current targets now. I'm still maintaining T3 for QQQ. That's the index I'm focusing on primarily. I'm watching them all, but that's the one I'm really, trading. And I'm going to go over that, some additional targets on there that we could see in addition if that T3 is even hit, assuming it is. And I'm also going to go over talk a little bit on bonds. I was out this morning. I did a closing on a mortgage refinance. I told you guys I moved back in January 2020. Got a what I thought was a really good rate back at the time on a jumbo, got 3.5%. And I was going to recast that mortgage, which is, we sold the other house a while ago and did some things. I was going to put money down on it and recast. They'll re-amortize your loan if you do a recast instead of just paying down, because that's not going to change your payments or recast. That's what they do there. But then I happened to take a look at rates, and I was, this is 6 weeks ago or so, locked in at 2.5. No points, and that's hard to beat. But I wanted to get to that now because it spurred, what's happened since then. Thank goodness these companies will do rate locks, but the rates have really started moving back up since then. And that same mortgage right now, that's you can go to bankrate.com for those of you interested in a new mortgage or refinancing. It's pretty slick. You enter your zip code, the amount you're doing, and whether it's a new purchase or a refinance. And they'll show you the best rates around, and it was Ally Bank, but that same one right now, gosh, I think it's today just to see because I closed to get that 2.5%. They're still showing that right now in my zip code, but you got to pay 1 3/8 points, which is thousands of dollars, depends on your loan amount, of course, but that's 1.375% of the mortgage amount. So that's what's happened. So in other words, the rate hasn't changed, but technically it has because your APR goes way up on that when you pay points up front. So I just kind of sidebar stuff, but it's again my segue into interest rates we're going to look at here. Forget about this chart. Let me just finish up on the equity markets, and then we'll go from there. So I'm going to give you right now two potential additional targets. You can see all kind of levels here, but T3 on QQQ, the one I've shared with you recently, comes in right around that 342, 41-ish level. I'm zoom in a little bit here. You have the 200-day simple and exponential averages right here, moving averages. They're almost together, and I put them both on my chart because some traders like the simple, some like the exponential. Right now they're flattening out, and they're right almost on top of each other. And again, I think it's a magnet. We haven't visited those in a while. Those are key moving averages in the market. In fact, certain charting platforms like stockcharts.com, for example, they have charts that you can key in a symbol, and they'll give you the percent that security, that stock, or that index, or QQQ, whatever you put in, the percent that it's trading above or below its 200-day moving average. So they're very key moving averages. They have been for a long time, and because of that, traders will flock to them, and usually buyers during corrections will step in and buy at the 200 days. Now I wanted to talk on that briefly. If it's not unusual, if we start to get some downside momentum, if we take out the recent lows, we'll probably have a pretty swift move down there. And remember, stocks tend to fall a lot faster than they rise. Here's a correction back here, and you can see in just a matter of what is that, maybe a couple weeks, we wiped out what took months right here in gains. Same thing, we rallied. It took that long, and then boom, in just a matter of week and a half, we wiped those gains out. So that's one thing we know. We saw it here when COVID hit. The market wiped out literally years of gains in take that back, in QQQ. So many stocks were, but in QQQ it was just over a year and a half of gains wiped out in a matter of 6 weeks or so. Anyways, that's the one constant that pretty much holds true. And so where I'm going with that is, if we get another thrust down and it's impulsive, there's a good chance we'll overshoot the 200 days as well as that 342.40-ish price support. And by overshoot, it could be a day, intraday, where during the day we break and then come back on it. Sometimes it's even intra-week. You might drop below the 200s and then recover back above or on them next week. And so, it's possible that we go right on through them like they're not there and keep going, but more likely get a reaction there. And that may be the end of the drop. And right now, that is my final swing target for the Qs. Whether it's going to be hit or not, that's still the one I'm maintaining. Now, with that being said, should things get ugly, and I always say the charts are dynamic, and so is my analysis, and I will let you know if and when we even get there, whether I'm going to extend a swing target down to 310.27, roughly. That's a rough, we'll call it 310, 310 a quarter, whatever you want. Pretty good support. So that would be a potential fourth target for swing or trend traders. And if things get really ugly, I've got a level down here. There's levels all the way in between, support levels where reactions are likely, but my maximum downside target, if things get really ugly, would be 267.50. And look, right now, this is nothing more than a run-of-the-mill correction. And so I'm throwing this out there because I want to get these out in advance, just in case all of a sudden we get in that, what happened, here, there was a big drop, what happened back in March of 2020, and you need to have your ducks in a row. So those are your targets, about 310 a quarter, 250, 267.56. Long-term targets. And by saying if things get ugly, well, let me tell you, from where we're at today, where we just closed, you're talking about another 25% downside or so to that target, to the 310.27 potential target, almost 14%. Okay, and that's the 60-minute chart. If I didn't hit on that yet, there's, we basically first leg down, we hit my second target to the button. It was mentioned as a good area to cover shorts, reverse for the bounce trade. Went in and backfilled that gap right there, that big old gap here. It's 61.8 perfect Fibonacci retracement, which is just a typical counter trend rally off the initial leg down. Had another leg down. And just the other day, we also retraced 61.8 of that leg down. So far, and that's why I'm still viewing this recent move up, and only time will prove me right or wrong, I'm still viewing this as a counter trend rally with another leg down to come. And so far, it meets that criteria. What will prove me wrong, or what will make me second guess, another leg down to that T3 or farther? Well, certainly a break of this trend line here. There's the primary trend line off the highs. We're still below it. Big resistance. So if we pop up, that's going to be resistance, or likely to be. It would also provide another objective short entry. And then above that, we have a big old gap and some pretty significant price resistance. So really, where I'm shading it in blue here, let me just do that for you. That is where, ideally, this QQQ should remain below to keep this scenario alive of one more leg down. If we take that out, the top of that blue range, especially the support zone or resistance zone above, it starts to sharply increase the odds the market's going to take another leg up. So favoring that. But again, with these divergences in place that we just put in on the 60-minute chart, one could certainly make the case for this as well. So trade it as you want. In a vacuum, seeing these divergences, if I could only trade this chart, I would be all in long right now, or at least maybe not all in long, but pretty aggressively long, because it's usually these 60-minute divergent lows where I look to cover all shorts and reverse to a long for a swing trade. But at this point in time, there's just so much evidence on the longer-term charts. I'm not going to spend a lot of time there. I do want to get to Treasury bonds. Let me show you one chart. Now, this is one of many that I've showed in recent months for using certain sentiment indicators. Sentiment, and it's pretty much how people feel. You have two types, I like to say, just kind of generically. You have your sentiment indicators like the bull-bear ratios, and those are where people are surveyed as to, hey, are you bullish or bearish on the market? Where do you think the market will be in 6 months or whatever it is? And like any other sentiment indicator, they're only useful, in my opinion. Only any value can be derived when they're at extremes. Anywhere in between, don't try to extrapolate any useful information. To me, it's just noise. Now, The problem with the bull bear ratios and things like that is I like to say that's people aren't necessarily putting their money where their mouth is. In other words, if I'm a member of the AAII survey and I say this week, I get the survey comes out once a week, I say I'm bullish. I could be foaming in the mouth bullish, all ready to just put everything I have into the market because that's what they're looking at. However, guess what? Something may change my mind over the next few days and I may not buy, invest or throw the last of my dry powder in the market. So in other words, while I might say I'm bullish, I'm not necessarily long, or I might not necessarily be long anytime soon. Whereas the put to call ratios, things like this, that's where people are putting their money where their mouth is. If there's more, if you see all of a sudden more put buying than call buying, now usually you're going to have more calls at any point in time, but when the ratio drops and you start seeing an increase in put buying versus call buying, that means people are bearish. They're placing bearish bets on the market. And yes, I know many put buyers out there are using puts solely for hedging purposes. They might be bullish and long, protecting their downside, but for the most part, again, that's why we look at ratios, and that's also why we smooth those out. And I like to smooth this one out with a 100-period moving average, and that's this blue line here. And I've gone over this one before, and what I pointed out is down on the bottom here I have the biggest drops that we've had in recent years, some of them. There was that bear market from October 07 into the March lows, about a 56% drop in the S&P 500. We had about a 20-something% drop there. We had two drops of about almost 20%, depending what index you're looking at. Some indexes did fall 20%, and we also went sideways for about a year and a half. And so the dotted lines show when those peaks came right there. I think you can see the dotted line. So there's the peaks. We're going back again years. This chart goes to the end of 03. And so what I noted that you get this extreme, and that's by using the 100-period moving average. It smooths out those spikes, little aberrations, and it tells you that the sentiment drops to this red line, which is just above 60. It hits that extreme months out. In some cases, and usually it's about 6 months or more. You can see here it hit that level right about what is that? Maybe July of 06. But then the top didn't come till just over a year later, and then it was a big top. Again, we hit it there, and that was just a few months, in that case, a few months before the top came, big drop. We hit it here, and it looks to be about a quarter or so, three, maybe probably about closer to 4 months there, and then that big drop came. Now we hit it here. What happened? Nothing so far. Remember, you hit it first, then the correction comes. So we're in line with the fact, right now we're talking, we hit it around the end of 2021, and it's getting a little bit stretched, but we haven't had any type of correction yet worth any notable correction, nothing really big. We're talking double digits, closer to 20% is what I mean by that. The one we just had was 10%. So that's it. So it may still be in play, but also note, look how much lower this is. It just shows that fear or complacency has reached such an extreme, and that's why I wanted to lay out those longer term targets for you. There's no indicator out there that works 100% of the time, or has for decades. Sometimes I'll show you an indicator and it has a 100% success rate if you go back 5 years, 8 years, 10 years. But you don't have that many periods. And, in statistics, you need to have a large sampling pool, a large number of incidents, and to say, okay, well, 3 for 3, but in the last few years, you got to go back longer. And I can tell you right now, when I go back longer, you're not always going to see that. So this is what it's looked like, where that magic number has been in recent years. And so that's all we can go by. It really doesn't matter because market conditions and even the options market and how traders used options was different 20 years ago than it was today, and it was even different 10 years ago. So that's why I like to use the recent numbers, and just wanted to point that out. Again, one of many, and what it speaks to is when you get to these conditions, it usually has pretty significant implications. So that's why I wanted to add those additional targets. Let's move away from this, talk a little bit about bonds, and then we'll wrap it up. Okay, I'm going to get to the charts of the bond ETFs as well as the interest rates, the 30-year bond yield and the 10-year. Before I do, because I don't want to forget this, if you're going to trade these, I'm talking about bonds in context with the stock market, what it may mean to the stock market. But for those of you that like to trade bonds, if you do, you're not going to make a whole lot of money trading TLT, the 30-year bond ETF, or IEF, the 10-year bond ETF, unless you put a lot of money into them, because bonds don't move that much in percentage terms, especially compared to things like the stock market or Bitcoin or crude oil or natural gas. So you can make money, you just got to leverage it up a lot. And that's what futures do for you. And again, if you trade bonds, I don't need to tell you that. You trade bond futures, they're already leveraged, so you get more bang for your buck. And I just want to point out, this is ZN for those of you who like to trade the 10-year. What I'm noticing, and I pointed this out last week, some nice positive divergences building. I would like it a lot better if I had a very clean downtrend line, and I don't. I can't draw a clean trend line off the high. I have a little minor one there, possible wedge, but again, it's a little bit fuzzy. There's not a lot of reactions. However, sometimes, and I'd like to point out, these divergent lows usually lead to a pop. Just like right here. So there was a divergent high. See, there was a nice clean up trend line, bearish rising wedge. There was your sell signal when it broke, and it led to this trend right here. And then you even had a longer term trend line get taken out, and we had another leg down. So there is the divergence, and it could lead to a bounce. I would like it much better if I had some really well-defined price support to step in at, but I'm going to get to that in a second. There is some support coming up on the 10 and 30 years when I look at the ETF. So I'm laying this out as a trade idea and also something that could affect the markets, because what would cause this to go up? No, that would be a drop in rates and a rise in bond prices, which would quite likely be caused by institutional buying, flight to safety, taking money out of stocks, putting them into bonds. If you're going to target anything, at least target that reaction high right now. But I think a move back up here. Let me give you the level, and then I'll move on to ZB right there. I think that's a likely swing target, 132, 231 for you traders of ZN, the 10-year Treasury note futures, and then ZB, the long bond. You have this is a 3-month chart. You can see a 60-minute chart, positive divergences here. By the way, ZN, I just showed you a 120-minute chart for 6 months of history. I'm going to do that here. Let me jump over that same time frame on ZB. ZB, there it is. There's your bullish divergence right there, pretty strong, just like you had on the 60-minute chart. And target is not super well defined, and again, support's not super well defined, at least on this time frame. But these divergences are likely to play out for a counter trend rally up to at least that previous reaction high. And so this could mesh with another leg down in the equity markets, maybe a drop down to my third target in QQQ. Now let's look at the ETFs and a couple other things, and we'll wrap the video up. So you have TLT. That's the go-to, first to market and most popular iShares 20 plus year Treasury bond fund. Basically, they're targeting the 30-year bond. They're holding bonds at least 20 years. Out to 30 years, that's the maximum duration that the government's issued for quite a while now, is the 30-year Treasuries. I think at one point they did 50 years, but I don't think there's any of those around anymore. I'm not sure if they're still out there, old ones, but that's moot. All right, here's the support right there, 140.69, and we're coming right up on it. And it's something we could hit in the overnight session. So I could see a little bit down, but we're so close to support. I think it's worth a shot, starting to nibble maybe at bonds here. I can't put a hard buy, but we did have a nice leg down, little flagging action, another leg down. We could continue to any of these levels. I just wanted to lay out the near-term outlook for bonds. I'm going to get to the long-term outlook in just a second. So that is the 30-year. IEF is the 10-year Treasury bond ETF, Treasury notes, and we had support. Not hard to find because you can see all these little pops above it, but rough support about 114.53. And same thing, we had a leg down there, a little bear flagging action, and we could go lower. So again, it's hard. I can't issue a hard buy signal right now, but with these divergences in place, You can see them here on the 60-minute chart of IEF, just like you have it on TLT as well, in the futures that I gave you, these little wedge patterns. So we're looking at maybe a near-term bounce here in the futures is what I think, and whether that's followed by another leg down or not. I'm not sorry, not the futures and bonds. But let me show you the rates themselves, TYX. Okay, this is the 30-year bond yield. And just like TLT had that range that it broke down from, remember, the yields are move inverse to bonds. When this is going up, TYX, TLT is going down. And there's no variation to that correlation. It's a direct correlation, unlike, you know, oil and the dollar or gold and the US dollar or anything else. Those can be on and off, but there's a, you know, direct relationship between rates and bond prices. And there it is. So this is coming up. You can see there was a support shelf, a little trading range back here, right? And we broke it there, back tested it. So there's the 30-year yield coming up on resistance there at about, you know, 2211 or 2.2%. And so that is, and there's that breakout of that range. So probably get a little pullback here soon, whether we get, you know, perfect kiss of that level or not. I'll speak to the longer term outlook in just a second. Let me just show you the 10-year TNX. 10-year just broke out of this downtrend line, not super well defined. You can move it around like that. Yeah, that's probably where it should be. Breakout there, and again, yeah, I just don't have solid levels here. But where I do have a better outlook or a view, I'm going to go all the way out here now, long term, and let's just focus on the 30-year. And remember, we've been in a secular bear market in interest rates since back in late 1981. That's where interest rates peaked. This chart populates the yields back to the late 70s right here, mid to late 70s. We were in a rising rate environment, very inflationary environment. Interest rates peaked out very high. You had the, you know, 15% on the 30-year bond right there at the highs. And then since then, we entered a secular bear market in rates. Remember, that's a bull market in bonds because rates were going down, bond prices were going up. And it was a very well-defined price channel. Rates were moving down, you know, in this channel for years. And what happened is, this is where the, you know, Fed gone wild started coming in when the financial crisis hit. Financial crisis completely of their doing. Well, them and Washington. Washington was to blame as well for the forcing lax lending standards onto the banks, making them lend to people that had no business buying houses because, you know, everybody should own a home. Well, we know now that's not true. But anyways, that was the first round of quantitative easing and stimulus, and then we had more rounds that took us down below the channel. Remember, there's the channel line. I've extended it. So that was our price channel. And then, you know, they were doing some big stuff they've never done. This was unprecedented, what they were doing here, to the, you know, extent of what the Fed was doing to, you know, buoy the financial markets and keep costs of lending very low. And then came the all-out nuclear option, where they just hit the, you know, hit the button, send the bombs, take whatever we have. And that's what they did when COVID hit, and that's what happened there. And it did, you know, crazy moves to bonds. And now, but what I'm getting at here is, we've snapped back since QE started back in '08. All the quantitative easing and easy money policies, we set up a new, below the primary channel, we set up this other trend line here, which we've now recovered. And look, we're starting to crack back into the bottom of the old channel. So I believe this is, you know, this is complete artificial manipulation of rates where they, you know, naturally would have been based on, you know, many factors out there. And we're back into the channel now. So look, will that continue? Well, there's really no more downside. We know this was the bottom. We're at near the bottom. We're talking, you know, fraction. This is, you know, this is 2% on a 30-year, you know, bond. There's really not much more downside to that. So at best case scenario, we stay in an uber low rate environment for years to come. However, if we go up, and this is where I'm getting at, watch this long-term trend line, this secular bear market trend line. Because if and when that's broken, and we got a little ways to go, it's not going to happen today or tomorrow or even next week, but if it's taken out, that means, and what could do that? Well, one of the things is runaway inflation. The Fed, all along, Powell's been dismissing this as transitory, brief, oh, it's only going to happen. Well, I can tell you this. You guys remember I told you about a boat back? Gosh, it took almost a year to come in, or was 6 months, 8 months. That boat builder and all of them, I follow this stuff online. They in just back in July increased prices 8%. So yeah, that's on $100,000 boat, which is bottom, pretty much low end of most boats nowadays. That's an $8,000 increase. A lot of their boats they sell at boat manufacturer 300,000, sometimes more. So do the math on that. And then where I'm going is just last week they just announced another 5% increase on top of that. So you take an 8% rate increase just back in July, 8% price increase across the board on all models, add that to another 5%, and they cited what's going on. Inflationary pressures. They've got to buy resin. They've got to buy electronics. All these things. Inflation's just runaway right now. And point is, they wouldn't have tagged on another 5% increase. People are not happy if they thought this was abating anytime soon. So this is kind of where I'm going with that. Inflation is bound to drive rates up. And on this, so let's look at this. Let's look at yields. Here we are right near on the 30-year. This is the historic 30-year. Let me make sure I'm all the way out. Let's try to zoom this in. Oh, there it is. Here's a better chart. All right, so here's one just showing you the long bond. This is, yeah, 30-year Treasury rate going back 39 years to 19. We don't need to go back much farther. Here's the point I'm trying to get at here. And you can see, during recessions they're shaded in gray. And here we're at near the bottom. There's a 2% mark, about where we're at today, give or take, on the long bond. And so let's look at something else. So now I can pull this chart here, and this is inflation rate by year. So now let's take a look at this one. I find this interesting. Look at that spike. And I can tell you this, and I've been saying it for years, and others say it, the Fed tends to grossly underestimate the actual rate of inflation. And if nothing else, even if you say they're accurate, they're the lag time. I don't have to tell you. If you've looked for a new car, people are paying above sticker on car prices. Rents have gone through the roof. Home prices have gone crazy, at least especially down here in Florida where I'm at. Bread, milk, gasoline, you name it, everything's running away. And so we know inflation's here. So let's just say that we know it's not going to abate anytime soon. These pressures are still up. Lumber, which I told you just broke out, those above resistance the other day, continues an uptrend, up another 5, almost 6% today. We know where crude oil is. We know where natural gas is. Things like that, all at multi-year highs now. And so, I believe this is only going to go up the next time it's reported here. All right, where am I going? Well, here we are back in. Let me give you the chart. Right here, 1990. The last time inflation was at this rate was back in 90, and you can see before that 88, 89. These are annual rates of inflation. So we're going to now look at the long bond, because bonds, one of the biggest impact of where long-term rates go, and that's why I'm looking at the 30-year TYX, is what the rate of inflation is. Because if you expect high inflation, you're going to demand a higher rate on locking your money away for 30 years. Otherwise, you're going to lose a tremendous amount of money in purchasing power. So we're going back to the 80s right now, and we can go back there, late 80s, 1990, and now let's just go back to that 30-year bond. What was the 30-year paying back in 1990? Remember, the Fed is keeping rates artificially low right now. So when you look at this, we're about 8% back then. Better than 8%, give or take, we'll call it 8%. So we're looking now at 2% on the long bond versus 8% back at the point inflation was at the same rate it is now, the first time when you go back in time, whereas inflation was as high as right now. So what this tells me is, look, there's going to be a mean reversion here. Either Powell's right and we're going to suddenly see everything turn around, and corn, wheat, and soybeans, and crude oil and natural gas. I think some of those will fall, but all of them across the board. And I'll tell you, a lot of times when prices are increased, in the store, when companies, and they haven't been able to do that for years, and I think that's one of Powell's follies, is he extrapolates. It's called recency bias. Producers have had a very hard time in passing along price increases to consumers since the Fed started their easy money printing back in 2008. So I think they became complacent with that and assumed that I was going to last forever. Now, finally, boom, cat's out of the bag. So there it is, guys. So all I'm trying to say is that's that's the most likely outlook for interest rates. I'll try to game the little near-term zigs and zags, but the charts indicate we're most likely, and fundamentals for this reason alone, the rate of inflation today versus where it was back in 1990, last time it was at this level, says that look, the long bond, pricing it at priced at 2%, is grossly underpriced as far as yields go. And just so I'm very careful with my words, grossly underpriced in yield means grossly overvalued in price. And I've been saying this now for the last couple years, and it's held true. One of the absolute worst. I can't promise where the market's going. I can't promise where lumber or crude oil is going, but what I can tell you is this is one of the worst times in history, the outlook for bonds, because there's virtually no upside. It really has to do with TYX. Bonds rise when rates fall, and with rates going near zero, and this is when I was harping on it back here, the best case scenario for bonds is rates stay near zero for years, bounce in this range, and we're talking between 1 and 2%, and you're going to collect a paltry 1 or 2% interest on which you're going to pay tax on. So you have virtually no price appreciation on those bonds, and you might get 1 to 2% if everything goes well, meaning if rates stay low and they don't succumb to inflation pressures and other things. Okay, so that's your best case scenario. Make about 2% a year on your money and pay tax on a portion of that. However, worst case scenario says if rates start going up, the value of bonds are going to drop, and you could actually lose 10 times what you're going to make in interest. In other words, you can lose 20% on the value of a bond portfolio in long-term treasury bonds, something like TLT. Which if you lose 20%, it's going to take you 20 years at 2% interest to make that 20% loss in principal up. And that's why the risk-reward rate outlook for treasury bonds to me is absolutely abysmal. I'm talking long-term now. And particularly, guys, keep in mind, particularly in your 401ks, bond funds, you buy a bond ladder to treasuries. You can look up that term if you're not familiar, where you have staggered maturities and you're buying individual bonds. Well, if you buy individual bonds, even if you do a ladder with CDs, you're guaranteed to get your principal back. And the worst case scenario, you're going to underperform a rising market with rates, but you're going to get your principal back. Bond funds, that is not the case because they're trading bonds. So you put 100 grand into a bond ladder today, ladder out 10 years, 20 years, you're going to get 100,000 back. You're going to collect interest plus 100,000 back. You put 100 grand in a bond fund, and rates do this over the next 10, 20 years, I'll almost assure you you're not going to get your 100,000 back because of the way bond funds work. So just be careful there. It's a big difference between putting money in treasury bond funds and individual treasury bonds, especially in a rising rate environment. So that's it. Video's going kind of long. Again, I'm painting longer term stuff here. I gave you some near term technical levels to watch on the markets as well as the treasury bonds. You can trade those if those divergences start to play out. I wish I could give you a hard buy, and if I had a sharp downtrend line or very solid support. And again, I showed you some decent support coming up on the daily charts. I just didn't have it on the 60-minute charts there. But here's mortgage rates. I think in the beginning of the video I told you I closed on a refi today, locked in 2.49% with no points recently. And here's these are nationwide averages. So far so good. That was 2.65 is the lowest the average 30-year got to, and we've been walking up higher, and I think that's going to be it. So I feel good where I'm at. I told you, bought the house, this house just back in January 2020, locked in at 3.5%. Then I thought that was good money, in a jumbo, and 2.5 tax deductible. It's like almost free money. And I'm looking at bank rate. I found that rate on bankrate.com. It's a great source for comparing mortgage rates in your area for new purchases or refis. And it's funny because Ally Bank, they were the one I went with. They were 2.5, 2.49 just again about 6 weeks ago. They still have that 2.49 rate up there, but you got to pay 1.375, 1 3/8 points right now on it, which raises your actual rate, your APR, up to about 2.6. And that's just be careful there. Don't fall. Sometimes the actual rate's a gimmick if you've got to buy that rate down with points. And so I'm looking across the board right now. It seems like the average, well, they're still the best out there right now at that rate. Most others are around close to 3% right now in a 30-year. And 15-year, you're always going to get a little better. But just want to point that out. I don't think the train's left the station yet. But remember, we're looking at cyclical or secular trends here, even cyclical. And I think this is where we're going to see the 30-year headed. And that in itself, if I'm right there on my longer term outlook, that also puts a very, very strong headwind on the stock market. So look, I'm not just talking about the next correction, the next bear market, more of a secular shift. If you see, I'm going to wrap the video up. I told you I would, but again, you're talking secular trends, and this is a secular, very well-defined secular bear market in interest rates, with rates falling over the last 30 plus years, and we begin a new secular bull market in rates. You overlay this with the stock market, you'll see that was a catalyst for a secular bull market in stocks. Stocks go up when rates are falling, and then if rates start to rise, and again, the Fed doesn't want to see this, but if inflation starts to or continues, and the Fed can't keep it in check, that's a likely scenario right there. But we're talking years, nothing that's going to happen today, tomorrow, next week. All right, I'm going to wrap it up here, and we'll pick it up tomorrow. We'll see what the stock market does. Watch those recent lows on QQQ. If we get even close to them, I think we're going to take them out, and then we could probably get that last leg down to T3. Otherwise, watch that overhead downtrend line on the 60-minute chart of QQQ. Break above that, it's likely to bring in some buyers. This has been Randy Finney with Right Side of the Chart. Have a great day.